What if everything you thought about investing was wrong? Over the past 15 years, the financial world has been flipped upside down. Tech stocks and crypto are crushing it. US stocks are leaving international in the dust. And bonds? They crashed right alongside stocks in 2022, betraying investors who counted on them for safety. Oh, and short-term T-bills are outpacing long-term bonds in a bizarre inverted yield curve twist. In this video, we'll dive deep into this chaos, breaking down each of these shockwaves and answering the million-dollar question: is diversification dead? Stick with me, we're going to look at the charts, data, and some surprises. Let's start with stocks, where diversification looks like it's been left for dead. If we compare $10,000 invested since 2016 in QQQ, which is mostly tech stocks, the blue line, inflation adjusted, it's grown to $37,245, completely dominating VTI, which is the Vanguard Total US Stock Index with nearly 4,000 stocks. It's fallen behind by over $12,000, growing to only $24,826. While VXUS had the worst performance, the Total International Stock Index with over 8,500 stocks globally only grew to 13.2 thousand inflation adjusted. It's a massive difference over the past 10 years. Diversification in stocks, it's not looking good. If you thought QQQ was great, Bitcoin was even more wild. On this chart, you can barely even see the growth of QQQ and VTI at the bottom, which just looks like a flat line compared to Bitcoin. Bitcoin, that $10,000 invested in 2016, would have grown to $1.77 million inflation adjusted today. It did not just beat QQQ, it completely annihilated it. But here's the catch. Not every cryptocurrency or asset won. Many of them crashed to zero. Many of them did very well. Now, is crypto the future, or is it just another risky bet? Now let's talk about the asset class that's supposed to save you when everything else fails: bonds. For decades, the 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard for safety. But in 2022, it failed to provide much protection. When stocks dropped 19.5%, the 60-40 portfolio dropped 17%, right along with it, bonds dropping over 15%. This is hardly the safety people were looking for. If we compare $10,000 invested starting in 2016 in these two portfolios, the difference is very stark. Over the past few years, bonds have lagged behind inflation, eroding real value. Even with the excellent stock returns we've had since 2022, the 60-40 portfolio has barely recovered to where it was at the end of 2021. Bonds didn't fail to protect, they also dragged the entire portfolio down. Then there's this. Short-term bonds like T-bills or SGOV have beaten intermediate-term bonds like BND with far less risk. Since 2021, the inflation-adjusted return of both has been negative. There's been much less volatility and loss in SGOV, the shorter-term bonds, which goes against conventional wisdom. This is because the inverted yield curve, where you can see the 1 to 6 month bonds are actually returning higher than the 2 or 5 year bonds. Even the 10-year bond, which is currently at 4.43%, is barely yielding more than the 6-month bond at 4.34. You simply aren't rewarded for taking the extra risk in bonds right now. And the old rules of bonds haven't been working recently. So if bonds can't save you and stock diversification has been abysmal, what are we supposed to do? This is all contrary to conventional asset allocation, which is based on Nobel Prize-winning academic research from Harry Markowitz in 1952, often called modern portfolio theory. It argues for diversifying across asset classes, or what it calls multi-asset class investing, like investing in the entire US stock market instead of concentrated bets in one sector like QQQ, or internationally instead of just in the US market, or leveraging bonds to decrease risk and boost risk-adjusted returns. This concept is often shown with this efficient frontier graph. It doesn't purport to deliver the highest returns, but the best risk-adjusted returns. And this is where you see the point there with the 60-40 portfolio delivering one of the best risk-adjusted returns from 1970 to 2020. I made a video going into far more details of modern portfolio theory, which I'll link up here and below. Multi-asset class investing has been called the only free lunch in investing, but in the past 15 years, it has been far from a free lunch. It's looked like a disaster. Let's take a step back and rewind a little farther than the past 10 to 15 years. Let's go back to 2000 to 2010. Again, we're looking at portfolios where you invested $10,000 at the beginning of the 10-year period. We're comparing the gray line 50% in US and 50% in QQQ, the tech-heavy, innovation-heavy ETF, which had the worst performance over this 10-year period, resulting in an inflation-adjusted loss over 10 years, losing over 30% of the value, ending with $6,714. And in just under 3 years, it had lost over 65% of its value, dropping to $3,500. While the blue line is a bit more diversified, having 60% US and 40% international. The drop was much less worse in both cases in 2000 to 2003, and then again in 2008 and 9. And it almost recovered, breaking even with inflation over 10 years at 95.68. Now the green line performed the best over this period. And that was a 60% stock, 40% bond portfolio, where 40% was in US stocks, 20% in international stocks, and 40% in bonds. The volatility was much less. It only dropped to 7,500 approximately in 2003, and then again to just over 8,200 in 2008 and 9. And it actually had an inflation-adjusted gain over this period with two of the larger stock market crashes in history. So back in 2000 to 2010, diversification saved the day. Bonds cushioned stock crashes, and international stocks outperformed. And this led to overall increased returns for the investors, especially adjusting for risk. Let's switch to a retiree portfolio for this same scenario. Instead of starting with $10,000, we're going to start with $1 million and withdraw $10,000 every quarter. As we can see, the scenario would have been devastating for a retiree if they didn't have diversification. With the heavy QQQ concentrated portfolio ending the 10-year period with over an 85% reduction in portfolio value, while some diversification with US and international 100% stocks only dropped to $422,000, almost a 60% loss in value, where diversifying with bonds did the best, only dropping to $671,000, barely over 30% loss in value. It's a major difference for retirees that are no longer adding to the portfolio, but actively taking money out of it. If today were 2010, would you be arguing to overweight your portfolio in big tech? Would you be abandoning bonds or jumping into crypto, which had just emerged onto the investment scene? Are we really in a better spot now in 2025 to make the best decision for the next 10 plus years? Bank of America has recently thrown in a big twist. They released a report warning that we may have a massive bubble in US stocks. This chart shows the US versus ex-US or international relative performance. This is because US stocks are now at a record 75-year, possibly all-time high, approaching 3.3 times outperformance over international. This is multiple standard deviations beyond historical norms. Part of this is due to higher innovation and growth driven by big tech in the US. They're poised to capture a lot of the AI market, and investors now expect stronger growth in these US tech companies to continue and are paying higher multiples as a result. Is US big tech or crypto outperformance the new norm? Or are we just in a big bubble and are international and bond diversification still worth it? Before you jump on the tech, crypto, or short-term bond bandwagon, or even ditch bonds altogether, there's a catch. Concentration can backfire fast. Yes, QQQ and US stocks have crushed it, but will that continue? They currently have historically high PE ratios and relative performance to international stocks, as we saw from the Bank of America chart. This is fueled by good track records of growth and prospects of more growth. However, successful companies could have disappointing stock returns if growth merely slows. They could still continue growing, be profitable companies, but have disappointing stock returns due to slowing growth. The difference between 10 and 20% growth is massive when you factor it into stock prices. Bitcoin has been a beast, but many crypto assets have gone to zero. You need to believe in its value and hope the market continues to be willing to pay more and more year after year. Short-term T-bills look safe now, but history suggests longer-term bonds typically outperform them over decades, and that short-term bonds like T-bills barely beat or even lose to inflation over the long term. 2022 was a bit abnormal, with the end of the greatest bond bull market in history. It had a 40-year run, but ended with increasing rates, surging inflation, coinciding with a falling equity market. Bonds failed in 2022, but they have historically provided an increased risk-adjusted returns in portfolios. A lot of these trends are self-reinforcing. Investors see some stocks, sectors, or countries have provided higher returns, so they start selling other positions to concentrate in those winners. This drives up prices, resulting in even more outperformance. When these trends reverse, it can be quick and it can be really ugly. Do you actually have an edge to pick the winners, or are you just chasing yesterday's gains? I'll be honest, I don't have a crystal ball, but I believe there is a lot of recency bias and performance chasing here. The past 10 to 15 years favor US tech, crypto, and short-term bonds, but 2000 to 2010 told a different story. Diversification failed recently, but it saved portfolios before. I'm skeptical we're in a new era. We have to make the best decisions with the information we have. Just because you've got a bad result doesn't mean you made the wrong decision. For those who got better results, overweighting US tech, crypto, or abandoning bonds, or even shifting to short-term bonds in the past 10 to 15 years, I'm not sure this was actually the correct decision for them. I'm skeptical they would have made these same decisions in 2009 or 2010. Maybe you have an edge, unique knowledge about tech, crypto, the US versus international, or bonds. But ask yourself, are you making decisions based on solid insights or just chasing what's hot? What do you think? Has diversification lost its magic, or is it still your best bet? Drop your thoughts in the comments. I want to hear from you. We've looked at some wild shifts in investing. Diversification is on trial, facing a death sentence. But the question remains, what's your move? If you enjoyed this deep dive, press that like button, subscribe for more content like this, and check out my video on modern portfolio theory linked below. Let's keep this conversation going. See you in the comments. Later.